Thank you for joining the Boeing Company's first quarter 2026 earnings conference call. Introduction and key executives. The call was led by Kelly Ortberg, Boeing's President and Chief Executive Officer, and Jay Malave, Boeing's Executive Vice President and Chief Financial Officer. Overall performance and outlook. Boeing is off to a strong start in 2026, building momentum across all three business segments: commercial airplanes, BCA, defense and space, BDS, and Boeing Global Services, BGS. The company remains on plan and is focused on safety, quality, disciplined execution, and elevating operational performance to deliver on its record backlog of nearly $700 billion. Key financial metrics. Consolidated revenue, $22.2 billion, up 14% year-over-year, driven by solid growth across all segments. Operating margin, 2%, a decrease primarily due to lower FAS/CAS pension adjustments, partially offset by higher segment earnings. Core loss per share, 20 cents, an improvement from the prior year, attributed to segment growth and other non-operating earnings improvements. Free cash flow, a usage of $1.5 billion. This was better than initially expected, largely due to a strong recovery from the 737 wiring issue and favorable collection timing. The company anticipates second quarter free cash flow to improve, with the second half of the year turning positive. Full-year free cash flow outlook remains positive, projected at $1 billion to $3 billion. Commercial airplanes, BCA revenue, $9.2 billion, up 13%. Operating margin, negative 6.1%, an improvement driven by higher delivery volume and a favorable accounting adjustment, partially offset by the dilutive impact of the Spirit AeroSystems acquisition. Deliveries, 143 airplanes in the quarter. 737 program. Stabilized production at 42 airplanes per month, with plans to increase to 47 per month this summer. Deliveries were impacted by a recent nonconformance finding on aircraft wiring affecting 25 airplanes, all of which have been reworked and mostly delivered. The full-year delivery goals and the rate increase plans remain on track. The new Everett North line is being prepared for operations later this year to support rates above 47 per month. 787 program. Delivered 15 airplanes, meeting expectations. Full-year deliveries are still projected between 90 to 100 airplanes. Deliveries were impacted by delays in premium seat certifications. Production is stabilizing at 8 per month, with plans to increase to 10 per month later this year. 777-9. Progress continues on certification testing, with FAA approval for the next phase of testing, TIA-4A. A potential durability issue on the engine, identified in a previous quarter, is being addressed by the supplier, with a fix expected. First delivery is still targeted for 2027. A significant effort is underway for change incorporation on built aircraft. Defense and space, BDS revenue, $7.6 billion, up 21%, driven by higher volume on KC-46 tanker, missiles and weapons, and classified programs. Spirit contributed approximately $150 million in sales. Operating margin, 3.1%, an increase of 60 basis points, due to improving operational performance. Orders, $9 billion booked, including awards for E-7A wedge-tail development and international KC-46 demand. Backlog grew to a record $86 billion. Highlights: continued progress on development programs with active management and program rigor. KC-46 tanker factory performance is near pre-pandemic levels, on track to deliver the most tanker aircraft since 2019. MQ-25 high-speed taxi tests are complete, with first flight imminent. Significant investments are being made to meet evolving defense needs, including an agreement to expand PAC-3 seeker production. Boeing Global Services, BGS revenue, $5.4 billion, up 6%, 13% excluding the Digital Aviation Solutions divestiture, reflecting increased government volume. Operating margin, 18.1%, down from the prior year due to the divestiture and a less favorable mix. Both commercial and government businesses delivered double-digit margins. Orders, $8 billion. Received, with a book-to-bill ratio of 1.6, led by strong government business intake. Backlog, record $33 billion. Highlights. Notable wins include a large maintenance and support contract for the UK's rotary wing enterprise, and the largest landing gear exchange contract in Boeing's history with Singapore Airlines. Automation and AI are being implemented to reduce proposal cycle time. FAA and ESA qualification for 777-9 training devices has been achieved. Management's forecasts and future outlook. Full year 2026 free cash flow, still projected between $1 billion and $3 billion. Longer-term cash flow, expected to grow significantly beyond $10 billion, driven by higher commercial deliveries, steady performance improvements at BDS, and continued growth at BGS. This growth is underpinned by the nearly $700 billion backlog. BCA margins, expected to see progressive improvement sequentially throughout the rest of 2026, with margins turning positive mid-2027. This is dependent on delivery volumes and cost-base extensions. BDS margins, targeting high single-digit operating margins. The first quarter margin of 3.1% is expected to see slight improvement, with a full-year estimate around 3.5%. Significant risk factors. Geopolitical instability. The ongoing conflict in the Middle East is a concern, particularly regarding potential impacts on fuel prices and the aftermarket services business. However, Boeing has not seen any requests for delivery deferrals from Middle Eastern customers and has delivered aircraft as planned to the region. The company has flexibility to resequence aircraft deliveries within the 12 to 18-month timeframe. Supply chain challenges. While progress is being made, selected supply chain delays, particularly in interiors and engines for the 787, and ongoing work with suppliers for rate increases on the 737, remain areas of focus. Certification timelines. Delays in obtaining certifications, such as for premium seats on the 787 and ongoing work on the 737-7-10 and 777-9, can impact delivery schedules. Spirit AeroSystems integration. While the integration is progressing well, further improvements are needed from Spirit AeroSystems to support planned rate increases. 777X change incorporation. A significant effort is underway to incorporate changes into approximately 30 built 777X aircraft over several years, which is a complex and lengthy process. U.S.-China relations. The outcome of U.S.-China negotiations is a critical factor for a potential large aircraft order from China. Highlights. Solid start to 2026 with revenue growth and improved delivery volumes. Stabilization of 737 production at 42 per month, with plans for further increases. Significant milestones achieved in defense programs, including the Artemis II launch and progress on KC-46 and MQ-25. Strong performance and record backlog in Boeing Global Services. Improved free cash flow outlook compared to initial expectations for the quarter. Positive outlook for longer-term free cash flow growth beyond $10 billion. Successful rework of 737 wiring nonconformance issues. Positive customer interactions and willingness to pull forward deliveries if opportunities arise. Strong defense market demand, with increased operational tempo and rising defense budgets benefiting BDS. Lowlights. continued operating losses in commercial airplanes, though improving year-over-year. Negative free cash flow in the first quarter, although better than anticipated. Delays in seat certifications impacting 787 deliveries. Complexity and duration of the 777X change incorporation process. Dependency on U.S.-China relations for a significant potential order. Spirit AeroSystems integration requires ongoing focus and improvement. Most important statements from CEO Kelly Ortberg. We remain on plan and are building momentum from solid performance across all three of our businesses. Our commercial airplanes team continues to integrate our safety and quality plan into its operations, which has enabled us to increase production rates and deliver high-quality airplanes to customers around the world. The resilience of our industry has always led to a recovery and return to growth trends. Our market remains robust. We are confident in our business, customers and markets, and our team remains squarely focused on safety and quality, disciplined execution, and elevating operational performance so we can profitably deliver on our record backlog of nearly $700 billion. We're making measurable progress. We're restoring trust with our customers, we're increasing production rates, and we're on track to generate a full year of positive cash flow. Most important statements from CFO Jay Malave. Consolidated revenue was up 14% to $22.2 billion, driven by solid growth across all three segments. Free cash flow was a usage of $1.5 billion in the quarter, but was notably better than expectations, largely driven by the solid recovery from the 737 wiring issue and favorable collection timing late in the quarter. We continue to expect positive free cash flow of $1 billion to $3 billion this year, aligned with the expectations I shared last quarter. Beyond 2026 and consistent with what we discussed previously, cash flow is expected to grow primarily driven by higher commercial deliveries, steady performance improvements at BDS, and continued growth at BGS. The way I look at that business, BDS, I simplify it into three elements, which I refer to as the 3Ps: performance, process, and price discipline. BCA margins this year, we still expect progressive improvement sequentially throughout the rest of the year. And that will, again, carry over into next year where we expect the margins to turn positive mid-next year. This concludes the summary of Boeing's first quarter 2026 earnings call.